intelligent investor. Chapter 1: What is an intelligent investor? The Intelligent Investor is considered a classic guide to finance and investing. First published in 1949, it has since been updated multiple times. Its current version combines the work of its original author, economist and financier Benjamin Graham, and financial journalist Jason Zweig. Its lessons about investing in the stock market were groundbreaking in their day and remain hugely influential today. The billionaire Warren Buffett considers The Intelligent Investor his personal Bible of investing and credits the book for his success. The book outlines a technique called value investing. Value investing rests on the assumption that day-to-day stock prices don't always represent the value of a company. As traders on Wall Street buy and sell stocks, they are constantly reacting to each other's choices. Stock prices fluctuate based on how much other traders are willing to pay for them. As a result, Graham argues, many stock prices reflect a kind of Wall Street groupthink rather than a company's actual value. Practicing value investing requires ignoring short-term trends in pricing and instead determining how much a stock is really worth based on the health of the company. Because it focuses on long-term outcomes, value investing requires patience and emotional discipline. A value investor must be able to ignore the short-term fluctuations in the price of the stock, especially if it dips. And they must ignore the choices that other traders are making. This requires a strong ability to think for oneself. These, for Graham, are the most important traits of an intelligent investor. He outlines the 3 principles that are key to intelligent investing. First, intelligent investors must analyze a company comprehensively before buying its stock. Second, they must take care to guard against any major losses by maintaining a balanced portfolio. And third, the goal should be satisfactory long-term performance. Don't set your sights on major windfalls in the stock market. The aim of becoming an intelligent investor and following those principles is to find long-term success at growing the value of your portfolio. The main ideas. Chapter 1. Value investing is an approach based on the idea that stock market prices do not always reflect a company's true value. Determining a company's true value requires research. Intelligent investors ignore short-term market trends and focus on long-term portfolio growth. Chapter 2: The difference between investing and speculating. The first step in becoming an intelligent investor is understanding what investing truly is. Graham argues that most people confuse investing with speculating. A speculator buys something based on the belief that someone else will be willing to pay more for it later. Speculators are not necessarily concerned with how much something is truly worth. Rather, they are interested in how much other people will think it is worth. Therefore, a speculator must watch the movements of the stock market very carefully. But no matter how carefully they watch market trends, speculators always take on a great deal of risk because they are relying on others' opinions rather than facts. Speculating, taking a risk and buying stocks in the hopes that their price will go up, can be fun, but it should not be confused with investing. Investors, like speculators, cannot truly know whether a stock will go up or down. No one can predict the future. However, intelligent investors research a company deeply. This research gives them a better understanding of a stock's value because their evaluation of a company's prospects is rooted in facts. And this allows them to gain some ability to predict a company's long-term success. Another misconception about the stock market, Graham argues, is that the greatest returns come from taking the greatest risks. This leads people to believe that if they cannot afford to take a risk, they should not expect to make very much profit. Graham disagrees. He believes that the rate of return is dependent on the amount of intelligent effort an investor is willing to bring to bear on his task. He believes that if you are buying a stock, you should be so confident in its value that you don't even need to know what its price is. All you need to know is that you believe in the company's promise enough to want to own a share in it. More specifically, you should feel very confident about 2 things. 1. Your initial investment, or principal, will be safe. 2. Your principal will grow at least a little bit. The main ideas. Chapter 2. Most people confuse investing with speculating. Speculators care less about a stock's true value and more about others' opinions about that stock's value. Thus, they focus on market trends. Intelligent investors know that their rate of return is tied to a company's true value. They focus on facts and research. Chapter 3: How to determine the value of a stock. How can an average person estimate a company's value and predict its long-term prospects? Many look at the history of stock prices in order to assess their value, but Graham believes there's a better way to acquire knowledge of a company. The basis for that knowledge lies in a company's annual financial reports. These convey key information like a company's profits, how much product they are selling, and whether they are able to cover the interest on their debts. Graham's approach involves studying at least 5 years' worth of these reports before making a decision to buy a stock. What should investors look for in these reports? The goal is to be able to predict a company's future earnings, which involves looking at several key areas. The first is general long-term prospects, or a sense of how external factors may impact the company. For example, an investor buying stock in an oil company should understand forces that impact the oil industry, like supply and demand, and geopolitics. The more you know about an industry, the better you can predict how well it will do as a whole. And you'll be much better equipped to compare different companies within that industry and decide what stocks to buy. The second area to study is management. It's important to evaluate whether a company's leaders are strong, competent, and making sound decisions. Third, intelligent investors take into account the strength of a company's financial position. That is, do they have enough cash, or are they in a lot of debt? Once you have a robust sense of a company's value, you can compare your estimation of its value to its price on the stock market. This will allow you to determine which stocks are priced lower than you think they should be. These are the stocks you want to buy. Once you've done your research, there are two different, but equally valid, approaches to intelligent investing. We'll cover these two styles next. Which one you choose depends on the risks you'd like to take, and whether you prefer a hands-on or hands-off approach. The main ideas, Chapter 3. To estimate a company's value, Graham recommends studying its annual financial reports for the last 5 years. These reports will reveal information about a company's long-term prospects and leadership. Invest in stocks that are priced lower than you think they should be. Chapter for the defensive investor. Graham outlines two approaches to intelligent investing that are tailored to different needs and desires. The first is a passive or defensive. This approach is best for a hands-off investor, someone who doesn't want to think about their investments all the time. The defensive investor selects a number of stocks to invest in over the long term, creating a portfolio that runs on autopilot. This is pretty simple, but it requires a few decisions. The first choice lies in how to allocate money between cash, stocks, and bonds. Graham suggests keeping at least 25% of your assets in bonds, which remain stable regardless of the fluctuations of the market. Determining how to allocate the rest of your assets depends on the level of risk you are able to take on. If you feel comfortable taking on some risk, then you can allocate most of your remaining money to stocks. But if you'd like to assume less risk, then you should increase the percentage of your money in bonds to 75%. Crucially, change this allocation only when your life circumstances change. Do not invest in more stocks just because the market has gone up. If your life circumstances don't change, keep your percentage allocation stable by rebalancing them every 6 months. For example, say you start with 70% stocks and 30% bonds. If the market rises by 25% but your bonds remain stable, you will now have 75% of your assets in stocks and only 25% in bonds. To retain your original ratio, you should move some of the stock money back to bonds. It may seem like defensive investing is an easy approach. Defensive investors can then largely ignore these accounts with the confidence that they will continue to grow slowly over time. However, Graham warns that this approach, while low effort, can be extremely difficult emotionally. That's because you'll need to ignore the fluctuations of the market. Many people will panic and feel a sudden urge to sell when they see their stock prices drop. But defensive investors know that selling low is a foolish decision. A defensive investor remains confident, knowing that over time the market will rise and their stocks will be valuable again. The main ideas, Chapter 4. Defensive investors take a more hands-off approach to their investments. Once they decide how much of their assets to allocate to stocks, bonds, and cash, they maintain a stable portfolio. Being a defensive investor requires patience and emotional discipline, especially when the market drops. Chapter 5. The enterprising investor. The second approach to intelligent investing that Graham describes is called enterprising investing. Unlike the defensive investor, the enterprising investor wants to play an active role in managing their money. They have an appetite for competition, for keeping a close eye on markets and industry changes, and for taking on intellectual challenges. They spend time and effort continually researching, selecting, and monitoring a dynamic mix of stocks. You may be wondering, why do they need a mix? It's true that the biggest fortunes in America were frequently made by betting big on one particular industry or company. However, it is very difficult, if not impossible, to make a smaller fortune that way, and it is also impossible to maintain a large fortune that way. This is because individual industries inevitably have periods of decline or contraction. These will destroy a fortune that rests solely on that industry. Thus, Graham suggests collecting a healthy mix of valuable stocks. When choosing which stocks to buy, ignore the hottest stocks at any given moment. When companies are growing rapidly, the price of their stock may begin to outpace their actual value. If you have paid too much for a stock, then you have not made a smart decision as an investor. On the other hand, when a major stock falters or falls for a temporary reason, that may be a good time to buy. For example, in 2002, Johnson & Johnson stock fell 16% in one day following a scandal at one of its factories. Suddenly, the stock was a good deal because it was low-priced, but sure to go up again due to the company's overall strength. Even if you want to take an active role in managing your money, Graham does not recommend day trading. Day trading is the practice of buying and selling stocks, all within the same day. Day traders capitalize on small fluctuations in the market, always hoping to come out ahead. This will not make you money in the long term, Graham warns. However, because your broker or brokerage service takes a fee for each trade, they will be the ones making money. Graham also cautions against IPOs, or initial public offerings, buying stock as soon as it becomes available to the public. While this may seem like a way to get in early on a potentially huge opportunity, the likelihood that you found the next Microsoft is low. What's more, major investment banks and other funds generally get the first offerings, so the general public can't truly access the good deals. The main ideas, Chapter 5. Enterprising investors want to play an active role in managing their money. Enterprising investors should invest in a dynamic mix of valuable stocks. Graham recommends against day trading and investing in IPOs. Chapter 6. Assembling your own portfolio. Once you've chosen your approach to value investing, what's next? If you've decided to be a defensive investor, then your path is simple: invest in an index fund. An index fund holds every stock worth having, a selection from the entire market. You can put all of your assets into an index fund and safely ignore it over the long term. If you enjoy researching and selecting stocks, you can reserve some money with which to do so, while still largely taking a defensive approach. However, Graham still recommends keeping at least 90% of your investment assets in an index fund. With the remaining 10%, defensive investors should invest in companies valued at $2 billion or more. Enterprising investors can take a slightly different approach to building their portfolio. Graham emphasizes that for most people, index funds are still the best way to invest. Picking one's own stock is incredibly risky, even for professionals and seasoned experts. Before you pick stocks to invest in, Graham recommends practicing your picking strategy with fake money for at least a year. There are websites that offer this service, allowing you to pretend to select and invest in stocks without using real money, to test drive your techniques. At the end of the year, you'll see whether you made or lost virtual money, and whether picking stocks is right for you. If it is, still proceed with caution, and remember to focus on low-priced stocks. If, after doing extensive research, you determine that these stocks are being undervalued, then you know it's the right time to buy them. Analyze the company's track record, its leaders, and its competitors. And, crucially, study the approaches of highly successful investors, study which stocks they own. Most important of all, develop your own approach, and stick to it. No matter your approach, stay focused and committed to your goals and principles, and ignore market trends. Even the intelligent investor is likely to need considerable willpower to keep from following the crowd, writes Graham. The main ideas, Chapter 6. For most people, index funds are the best way to invest. Defensive investors should put at least 90% of their assets into an index fund, and up to 10% in companies valued at $2 billion or more. When picking their own investments, enterprising investors should focus on stocks that are low-priced and undervalued.